Okay, so hello everyone. So my sincere thanks to Susan and to the IGIDR for the opportunity to be here today. It really is a tremendous privilege to have the chance to be in this awesome room full of tremendous thinkers, scholars, and practitioners in the field of the stuff that I study and do. This is an incredible opportunity for me to bring this paper over here and to get your thoughts and comments on this issue. So in the broadest sense, my research examines questions of how innovations in market design impact sort of really core established concepts in finance and securities regulation, such as fraud, manipulation, and insider trading. Right? So in past work, I've looked at whether or not credit derivatives, like credit default swaps, for example, whether these instruments push the boundaries of the traditional doctrine and policy of insider trading. And because Star Wars is opening tomorrow, right, I thought in honor of that, we would start looking at how automated trading, right, how the sort of change and transition to automated markets similarly is challenging, creating tensions with how we understand information flows in today's markets to flow and the allocation of informational rights in today's sort of modern market design. So that is the sort of major sort of goal and motivation of the paper. So as you guys know, modern markets have seen a tremendous transformation over the last decade, right? From the sort of very sweaty, hairy trading pits of the last sort of 20, 30 years, we have moved into an extremely sterile, highly automated marketplace. So instead of relying on human beings to submit orders, to route those orders, to execute the trades and finally complete them, right? We are in a world today where all of these tasks can be reasonably and reliably delegated to algorithms. Pre-programmed, computerized instructions that can basically organize and distribute almost all parts of the trading process. And today in the US, algorithmic trading and high-frequency trading has really taken off tremendously. Today, equity markets, we're seeing 50 to 70% in equity volume in the US driven by high-frequency trading. It's 60% in the futures markets. And somewhat surprisingly, over the last sort of 2 or 3 years or so, we've seen an enormous growth in the US in trading in US treasuries using the high-frequency traders as a critical part of the treasury trading platform. That market has moved from being a really sleepy, boring market into something that's high-tech, fun, moving, and fast, right? And for some, this represents a source of concern, but that's sort of another issue that we can think about, maybe talk about in Q&A. Here in India, since 2008, since algo trading became legal, we have seen approximately 33% equity volume on the NSE driven by high-frequency trading. This is actually a pretty cool thing, right? Computers are cool, right? They do not check their phones every 2 minutes, right? They like to do math. They are awesome, right? So we have seen many myriad benefits coming from the use of automation in today's securities markets, right? We have a highly data-driven market. We have a market which is liquid, which is fast, right? And in which, interestingly, we have seen investors paying a lot lower commissions given the high efficiency and liquidity of the marketplace. I think most finance scholars today will agree that in the short term, market efficiency on many metrics has improved considerably over the last 4 or 5 years. Right? Today's securities prices are incredibly responsive to an enormous swathe of data in the marketplace, reflecting the changing dynamics in the short term and sort of being sensitive to a much larger amount of data than us human beings could ever hope to parse. But in order for trades to happen in milliseconds and microseconds, the servers, the traders need to be located right next to those of an exchange. Right? These traders, HFT traders, have to literally be hugging the exchange in order for trades to flow and information to be exchanged in microseconds and milliseconds. right? In addition to just having geographical proximity, we need traders to also have informational proximity. They need to be able to receive large amounts of data from different exchanges quickly in order to be able to trade. And finally, right, the algorithms have to be able to react automatically to all of this information. Us human beings, we are too stupid, right, to be able to inform ourselves, trade, receive all the information, and to parse it in real time. We need the algorithms to do it by themselves, right? So we have this unique combination of location, of informational proximity, and finally of automatic reaction. And what the paper argues is that these three unique factors put together gives HFT traders a structural advantage. That today's HFT traders have first sight of information coming from the exchanges. They can react to this information and change prices well before anyone on the outside has seen that original information. So what the paper seeks to argue is that this cohort of HFT traders have an outsized role in price formation owing to their first sight of market data. And the question for us is whether or not this elite, this sort of small cohort of traders and their first access to this information represents a challenge to traditional doctrines and policies and traditional ways of thinking about insider trading doctrine. So as you guys are aware that co-location is a practice that has really grown in the US, right? So we have these enormous data centers, most of them located in New Jersey, and Secaucus and Marwa and Carteret, because who actually wants to live there, right? So you have these sort of enormous data centers that are located there where the HFT traders are situated at a distance of, on average, 90 meters from the exchange server. Right, so the exchange server is located 90 meters from the HFT trader, enabling the information and the order flow to flow quickly between the exchange and the server. Right, and that is co-location, and that's a phenomenon that has been incredibly profitable for most of the exchanges in the US. They sell this space at a considerable premium. Right, this is prime real estate, and exchanges have benefited greatly from it. The SEC does not impose very many restrictions on this practice beyond the simple fact of requiring exchanges to give notice of the terms and conditions on which these co-location services are offered. So really, it's a very unregulated space in general in the US. In addition, right, the HFT traders benefit from extremely rich, detailed, awesome data feeds that come directly from the exchange. So today's exchanges sell their proprietary information to HFT traders for a hefty fee to give them information directly to their co-located servers. Right? And this information is extremely cool and awesome, right? The finance geeks will freak out if they see it, right? It's really kind of detailed, sort of full depth of order book. You get to see order imbalances through this data, giving the HFT traders a sense of where the market might be headed. This is in contrast to the public data feed in today's marketplace. So I'm sure you all have seen the ticker tape that is scrolling underneath the CNBC window that is on TV every single day. Right? That information, that public feed, is extremely, extremely, extremely crappy. Right? That public feed is comprised of very basic data. Just the best bid and ask offer in general. In addition, that data feed is also outdated, right? By the time that all the exchanges collect their best bid and asks, collect them together, pool them, and give an average, the HFT traders have already traded and made that information out of date, right? So the data feeds that are being sold and collected by the exchanges are something of a real sort of benefit to the traders who purchase and pay for them. All right, so here we have a diagram, which is very unusual for a lawyer to do, actually, just to make that clear. So here we have a diagram. So you can see from time zero, the stock price is $100. And here, right, we have time zero, the stock information. The information reaches the co-located HFT server at time 1, right? The HFT trader can then react automatically to that information at time 2, and this changes the price of the stock. But as you can see, as we flow along this timeline, when it gets to time 3, when the folks at time 3 see this information, it's already well out of date. The price has already changed, right? The HFT traders receive it, they trade on it, price changes. By the time this information gets to other people, the price has already changed, right? So we can see that there's an outsized role in price formation in this context. Now, coming to the earlier question we heard from this morning, right? Insider trading has generally been a very controversial area of the law. But most scholars are kind of agreed that there are 3 basic rationales that have driven the growth in insider trading laws both in the US and elsewhere. The first basic rationale is that of investor protection. This rationale seeks to argue that if investors are systematically outgunned, if they're systematically losing to a small cohort of insiders, then those investors will just simply give up, right? It will be rational for those traders to go home and watch TV and take their money elsewhere, right? So in order to keep capital markets vibrant, in order to keep capital markets flowing, we need some kind of level playing field to create the incentives for traders to come and sort of populate the marketplace. So the investor protection angle is arguably the strongest one that has driven the growth of most doctrines in the insider trading area. In addition, a much weaker rationale in the US is the equal access rationale, the rationale that everyone should have equal information. It's pretty clear that this particular equal access rationale has kind of died a death. We appreciate that in reality, we're not all going to have the same information, right? That's a given. In reality, we're not going to do that. But still, the law in places seeks to give investors some kind of equality of access to the information in the marketplace. One very important rule here is Regulation FD in the US. FD requires that if a public company speaks to a broker, an analyst, a nice investor, they must give that information to everyone. They cannot make selective disclosures of specific information to particular interest groups without making that disclosure to everyone. So there is some recognition of the benefit of equal access to lower the transaction costs of obtaining information for the marketplace as a whole. Now finally, coming back to the question of market quality, there's a real concern from the perspective of capital formation if investors are forced to leave the marketplace or pay more for that information. So again, these rationales sort of militate in favor of putting in place a sort of insider trading policy framework, recognizing still the cost that that framework can impose. So sort of skipping ahead, so the question really arises as to whether or not the structural HFT insiders, whether the ability of HFT insiders to get first sight of information and have this outsized role on price formation, whether that kind of structural insider trading replicates some of the harms that traditional insider trading law and policy has sought to diminish. Right? So examining some of that evidence, there's a case to be made to say that some of the HFT trading in that context does replicate those same harms. Now, coming to the question of investor protection, the early access that HFTs have to trading information really makes a difference, right? Finance studies have argued that HFT traders are incredibly efficient in the marketplace, right? These guys are able to predict the direction in which markets are headed by a few seconds, by 4 or 5 seconds systematically. This should not be surprising given the structural advantages that they have in having first sight of trading information. Right? So it is to be expected that HFT traders should be able to be highly efficient in predicting market direction and in trading in that direction successfully given their first sight of market data. In addition, some scholars argue that this first access creates systematic costs to other investors. Professor Civitanic and Kirilenko in one study, and Professor Hershey from the LSE in another study, show that investors, informational investors, are being systematically charged a very, very small fee over time that is a systematic cost on these investors versus the HFT traders. HFT traders are taking a little bit of the gain accruing to these information investors, and the question is whether or not the systematic cost is something that is something that we should be concerned about from this sort of perspective of traditional doctrine. Secondly, the equal access harm is perhaps more abstract, right? The question is whether or not we've reached a point in which there is a huge disparity between the public feed of information, the sort of general crap ticker feed, versus the extremely detailed direct feeds that are available to the HFT as well as other traders. Right, so the question is, how much disparity are we willing to tolerate in this context before we decide to take action to promote the equal access rationale more forcefully? Finally, sort of looking at questions of market quality, the evidence here as to whether or not investors are leaving the marketplace, the evidence here is much more mixed, right? So there's no clear study that's telling us that informational investors and informed investors are leaving the marketplace because HFT traders have arrived and systematically gain a small amount at their expense. But there is some anecdotal evidence. Increasingly in the US, we are seeing informed institutional investors leave the public marketplace in favor of going to dark pools. Just 3 or 4 weeks ago, a new dark pool was formed called Luminex. That was formed, ironically called Luminex, that was formed by the asset managers like BlackRock, right, who have custody of assets that represent over 60% of equity assets in the U.S. market, right? So maybe this trend is something that is showing and exemplifying the harms to market quality that scholars have been concerned about, and the question is whether or not this trend is real and persistent, and that's maybe something for finance scholars to study. In addition, Professor O'Hara and Yang, Professor O'Hara from Cornell and Yang, they argue that in fact there's a harm to market quality as well coming from exchanges selling information for profit. Professor O'Hara and Yang suggest that where investors are price uninformed, where investors have to pay a lot for the information, then they will not trade, or they will trade less. They will take their capital elsewhere or discount what they invest in the market to reflect their added transaction cost of participation. Right? So we see a real trade-off in this environment where investors face some gains, certainly, through lower spreads, but also face new costs in terms of data collection, getting information, paying for that information, and potentially losing a small bit of their gain to HFT traders. And so the question is this legal? And the answer is, in the US, of course it is. Right? Insider trading laws do not catch this at all. Right? They do not catch this because insider trading laws in the US requires deception. Right? It requires that there be no disclosure of this practice. But clearly this practice is legal. It's regulated by the authorities. And so the question really remains to be seen is what this means from more philosophically about the information costs that different actors bear in the marketplace. In particular, one might question how forcefully one can regulate and one can discipline corporate insiders for their kind of harmful insider trading, but not discipline structural insiders, even though that creates similar harms and similar costs to traders. Right, so this raises, I think, some really sort of deep questions and profound questions about this sort of different regulatory costs, the disparate allocation of costs in the marketplace, and how the sort of existence of HFT and the harms that it might create for informational costs, how this eventually influences and impacts insider trading policy more generally.
Thank you. The discussion, Bhargav.
Thank you, Susan, for inviting me for discussing this paper on insider trading and how do we really think about HFT trading in the context of information asymmetry. Now, while this paper is entirely located in the US context, I think to most of us it is really relevant, especially given that SEBI is now thinking about how do we regulate this animal known as high-frequency trading. Now, for me, the two biggest takeaways from this paper is, yes, high-frequency trading gives rise to information asymmetries similar to the kind that we see in insider trading. Two, I thought the paper was extremely, it was a great read because it was replete with examples, very practical examples, which I think gives the paper a very reality feel, and I think I urge you all to read it to understand how do you think about investors losing out because of lack of information that they do not have. I'll divide this discussion into four main parts. One is what are the main propositions of the paper. Second is I would like to draw a distinction between insider trading and high-frequency trading. Third is I would like to speak a little bit about when should the state intervene when there is an information asymmetry in the market. And fourth is I'd like to throw out some ideas before we really start thinking about regulating high-frequency trading. Now, what are the main propositions of the paper? The first proposition is that high-frequency trading creates information asymmetries between high-frequency traders and non-high-frequency traders. Conventional insider trading doctrine, which is meant to address information asymmetries, does not address this information asymmetry which arises from high-frequency trading. Conventional insider trading doctrine must therefore be revisited to address information asymmetries arising from high-frequency trading. So these are the main fundamental propositions. Now, what's the story? High-frequency traders have access to co-located servers, they have access to rich data feeds, and are therefore, by virtue of the algorithms that they put in place, able to react much faster to trade-related data than all of us are. By placing orders faster than the rest of the market, a high-frequency trader is able to stand between an informed investor and the best price on the market. What are the apprehensions that arise from this? Increased cost of trading, risk of capital flight, where traders like you and me just don't trade on the market because we are constantly scared of being shortchanged, and cloak and dagger behavior, where we increasingly spend a lot of money and costs on trying to hide our trade from high-frequency traders, move them to dark pools, and so on and so forth. Now, just to go back to the doctrine of insider trading. As Yesha pointed out, insider trading doctrine does have a lot of policy background, but what is the single biggest thing that really invokes liability for insider trading? So before we had, in the US, the whole insider trading doctrine really emerges from the Securities Exchange Act and Rule 10b-5, all of which is grounded in deceit, manipulation, and fraud. We have the classical theory of insider trading where if a corporate insider, in breach of his fiduciary obligation to the company, trades on the basis of unpublished price-sensitive information, he can be sued for insider trading. We have the misappropriation theory where a person, if in breach of his fiduciary obligation to the source of the information trades, it's a problem. So what do I mean? So in case of misappropriation theory, say a lawyer or an accountant, if in breach of his fiduciary obligation to his client actually trades, then it's insider trading liability under the misappropriation theory. So the whole edifice of insider trading is really a breach of a fiduciary obligation. There is deceit involved and there is manipulation involved. I don't think any of us would really deny that. Now, are these elements really present in the case of high-frequency trading? High-frequency trading is a combination of three things: co-located servers, access to rich data feeds, and automated response to trade-related data. None of this really involves fiduciary obligations, manipulation, deceit, etc. It can possibly involve, but as you cannot classify each and every high-frequency trade as something that involves deceit. Now, given this, what is the only common thread between information asymmetry that arises from insider trading and the information asymmetry that arises from high-frequency trading? It is some people have access to better information than the others. Now, information asymmetry, the way we think about it, is really a state of nature. I mean, there are two parties to a contract. One party to a contract is most likely to have better information than the other party to a contract. Does the state step in to intervene? Does the state step in to really equalize this playing field at all? Do all information asymmetries require or warrant policy intervention? That is something that we really need to think about before we even start thinking about high-frequency trading in the context of information asymmetries. So let's see some previous technological innovations which have given rise to information asymmetries, and let's see how we have sought to or not sought to intervene. So in the beginning, I mean, up to the 70s, we had trading on the floor of the exchange, the pit trading. Traders standing in the first row are likelier to have faster information than traders standing in the second and third row. That's why the first row was typically, there was a bid for getting a position in the first row. Did we really intervene to, say that nobody shall stand at a distance of less than so-and-so from the floor of the exchange? Okay, let's take a practical example. Imagine a situation where you are able to place an order on an exchange from your phone. People who have the 4G network will be able to communicate the order faster than people who have the 3G network. So these are the kind of information asymmetries that arise from tech innovations, and we really need to make a strong case for intervention before we get into the question of information asymmetry. There are some ideas that I wanted to discuss here. Is that popular discourse really categorizes all high-frequency trading as market abuse. Now, there is an inherent problem here. What is the biggest and the most common accusation against a high-frequency trader? It is typically front-running the other investors. So what happens? There is say, a trader A who sees that a scrip is trading at a particular price across 3 exchanges, and he likes that price, so he places an order for a given quantity of shares at that price. The order goes through 3 exchanges. After a part of the order is executed on one of the exchanges, he realizes that the price has already changed for the unexecuted part of the order. And so, what does he think? He thinks, oh my God, by the time I could buy 50 shares at my favorite price, high-frequency traders have intervened, have figured out my order, and have gone to the other exchanges and have bought out the shares and are now trying to sell it to me at 50 plus 1. So this is the accusation against a high-frequency trader. What has happened at the high-frequency trader's end? A high-frequency trader has, of course, gotten faster access to the order, to the size of the order on exchange A. He doesn't know who the order is coming from. He just knows that an order has been placed. It has been matched to this extent. It has not been matched to some extent. So what does he do? He goes to another exchange and buys up the shares. Now, here there are various ways in which the high-frequency trader himself could have made a loss, right? Because it may be that the trader may have said, oh, I got these 50 shares, half of my order was executed at this price. You know what, the price has changed, I'm going to cancel the remaining half. It could have been that the other high-frequency trader sold the other shares instead of the high-frequency trader who saw that order. So, I mean, in a platform where there is so much anonymity, it is very difficult to allege that every high-frequency trade is being done to purposely front-run somebody else. Imagine a situation where there was no high-frequency trading. Wouldn't this have been a normal trading route anyway? Wouldn't this have been a normal trading strategy anyway? So what we are trying to do is really, we are using the same trading strategy, but we just have the benefit of faster access. Now, therefore, presumption of guilt in all high-frequency trading and calling all high-frequency trading market abuse and trying to bring it within one of the buckets of market abuse, I don't think is a good idea. Also, what happens when a high-frequency trader is trading with another high-frequency trader? What would you do? I mean, is there an information asymmetry there? Is there deceit there? Is there manipulation there? I don't know. Second is a lot of attention has been focused on co-location of servers. Now, this is a dangerous path to tread on, right? I mean, if we go by distance of server of the trader to distance of the server of the stock exchange, are we going to possibly have a rule that within a 2-kilometer radius of the exchange, you can't have servers? It's a very delicate path that we are thinking on, and therefore co-location, I think, deserves lesser attention than it gets. There are other tools which are being contemplated, like introducing latencies for order transmission, keeping orders suspended for some time, etc., so that there is a level playing field. The questions now, even as we debate whether high-frequency trading brings efficiency and liquidity to the market, the question really is that whether introducing latencies or introducing suspension times will take away those efficiency or not. Now, I would just like to leave the audience with some thoughts, and that is, can high-frequency trading, why are we taking high-frequency trading as a separate, untamed animal? Can it fit within the general regulatory framework for market abuse? If high-frequency trading, it definitely generates more traceable data than other trading, should the regulator instead ramp up its enforcement capacity, ramp up surveillance, and wherever there is a market abuse, in the case of high-frequency trading, we treat it like any other market abuse by all means. But should we consider high-frequency trading in itself as a market abuse or insider trading offense? Thank you.
We have some time for questions. I just make a few remarks. I just wonder, Yesha, whether the subject will get more justice if it's not branded insider trading. Insider trading is about asymmetrical access to information about issuers. And that's why an insider who's inside and proximate to an issuer gets benefit of that asymmetrical access compared to the market. This is not to say this is not a policy issue or what degree of attention it deserves is up for debate. But I just thought I'll make that opening comment. So if there are any questions for, yeah.
Hello, my name is Bhagwan Chaudhary, I'm UCLA. Back in the days, before high-frequency trading became popular, we had models in which we had informed traders and uninformed traders. And by and large, we didn't like informed traders. We came up with all kinds of mechanisms to make them disadvantaged. If HFT is one of those mechanisms that disadvantages them, what's wrong? I mean, that seems like the right thing to do in some sense. I think the key here is competition, which is as long as HFT, there's enough competition, enough firms that are coming in who can front run these informed traders, they might end up making markets more liquid. So I'm a little confused.
Venkat?
Yeah, so I think I'm just going to take up from what you said about, there are two kinds of information, right? One is about the firms, and then the other one is the information about the order flow. And though those two are produced by different entities, and so when you talk about insider trading, historically it's been against the firms. But my question is slightly taking from what you were alluding to is, if you're looking at information about order flow, historically, as you said, there are a lot of cases where pits were more advantageous and so on. So since exchanges now have, they can profit from that information. See, previously it was just people who are members of the exchanges who were profiting. Now the firms can profit as well. Can we actually look at it more instead of calling it as insider trading, but more in terms of when this information becomes public? So even that has to be defined, right? So whether if the exchanges get that information from the order flow, then does that, the public starts from there, or is it going to the market through the feeds? So I think the definition of when it becomes public is very vague. And I think if you focus it on the exchanges, now who are players of data, and seeing whether they can do insider trading by actually profiting by selling information, then I think maybe there is some.
See, the entire paper was in the global context. So Indian context is quite different from the global context in the sense, Indian markets do the entire surveillance, investigation, order management, risk management at a client level, that is the investor level. Whereas globally, the other markets do on a netted basis at a member level. So we are on a different footing. And fortunately for India, HFT has been, actually we have dealt with HFT in quite different manner compared to global market. Global markets had no mechanisms to figure out who is trading at the last mile and all, whereas we were always fortunate enough to drill the markets down till the last mile. So our surveillance investigation is not leaving out HFT people also. So whatever filtration I am doing at surveillance, it includes HFT. So if we are talking about market manipulation and things like that, we are adequately geared up to handle it. So what I wanted to request the paper presenter was, can we look at Indian context versus the global context and figure out where we are in much stronger position, and what are the gaps, if at all any, we need to bridge. That would add value to the paper is what I guess.
If I may supplement, the US, I think there was evidence of kickbacks being given to the exchanges for supply of liquidity by the HFT guys, whereas I'm not sure that's the case at all. That's even possible structurally in India. So maybe that's the element of abuse that can be. Yeah, sure.
I think the interesting question the paper raises is the nature of the information. Is it a public good? Is it a commons that the exchange is transmitting, or is it a private good which is the property of the exchange data about orders? Till 20 years ago, it was not valuable. And when something is not valuable, people usually treat it like commons or public good. If it's not really valuable to me, I will not, put a price on it. I'll let you have it for free. But the fundamental change that has happened is that that information, the rich information at time now has become valuable. It has gained value. Oil was free before we got the internal combustion engine. But, and people were giving oil for free maybe if they had found it in their land or they were to get rid of it. But now it has. But we have to go back and ask the fundamental question, was it commons, exchange, ticker, trade, data commons, or was it private information? While I think it was private information, but you could argue on the other hand and say it was commons. And therefore, you cannot close out a commons, you cannot close out a pasture in law.
One more point, small point I would like to make. The way information gets disseminated and the structure of the market. In US, for example, 30% of the volume only happened on the recognized platform, whereas the 70% happened on the dark pools and like that. In India, there is no concept of dark pools. Whatever happens on the floor of the exchange. That explains significant difference between the global market and the Indian market. So given that scenario, while the paper is doing justice to the subject at a global level, because we are looking at value for us in Indian market, if you can also dwell upon Indian condition, that will be highly useful.
Okay, there's one more question here. Yeah, so 1, 2, and 3.
So just supplementing to what Venki had mentioned about firms publishing the information. So for it'll be good if you can look into the process of how this is done. If a firm publishes, let's say, earnings announcement, it goes on the exchange website. Is there preferential access to the high-frequency traders? So are there two different feeds? Are they published at different times? So then if they are not published at different times, if they are published at the same time, then it really becomes who gets faster access, who can pull out that information faster.
Yeah. Can we finish taking the questions? Because, yeah, sure. Go for it.
It gets published on the website first and then into the data feed.
That's good.
Yeah, okay, one question here and then one with Dr. Yadav. Yeah.
Thanks for the presentation, Yesha. Very quick question. So I think a lot of discussion has taken place on whether it's insider trading and the regulatory aspect of it. I was wondering, has there been any emphasis on the technological aspect of it? Because I think there was a case in the US, hedge fund Knight Capital, where a trade went rogue and the algorithm was automated, so it kept on doing these trades. And had it kept on going, then a multi-billion-dollar hedge fund would have become insolvent within an hour or so. So I'm just wondering whether, looking at the technical part of it, when the software goes rogue, is that something which the regulator should look at, or is that an internal risk management thing? Especially considering that these things can have a systemic effect, because these hedge funds are, they're massive in how much AUM they have. Thanks.
Yeah, there's one last question, then Yesha, the floor is yours. Yeah.
So I think one of the key issues and then I'm reacting to also the point which was made here about the Indian context. So the key issue, one of the key issues in the paper is the following. Here you have the information coming through a direct feed to the high-frequency trader, and because of automated execution, the high-frequency trader reacts to that information And before anyone else in the market outside this high-frequency trader group has had even the direct feed, the price has changed. So the true price of anybody outside the group does not have the ability to react to the information before the price has changed. I think that's a very key problem with this issue. And people can say, okay, why can't any informed trader or any of the people who are in this business buy up space on the exchange? Yes, that is certainly feasible. However, that has an enormous amount of fixed cost. So anecdotally, I think I may be wrong, but I think the NSE charges something like 14 lakhs to put up a co-located server. So there's a huge investment for each and every informed trader to go about getting to set up their own co-located servers. And so long that is not possible, you have a situation where nobody can react to the information before the price is changed. To my mind, that's a very crucial issue. And that's a crucial issue in India as well as anywhere else from the perspective of the insider trading angle. And in perspective of the point which Bhagawan made about informed traders, yes, we didn't like the informed traders, but at the same time, it's the informed traders who keep the markets efficient in a long-term sense. The HFTs also keep the market efficient, and a lot of finance studies show that they increase their efficiency in the market, but they increase the efficiency in the market at a very micro level. Yes, they make the market much more efficient at the second level or the microsecond level, but what about over a longer time frame? Now, clearly, there is no clear-cut answer to that question, and there are pros and cons, but I think we need to sort of keep the other issues in mind as well.
Okay, Yesha, 5 minutes to...
Great, so thank you all very much for these comments. My sincere thanks, first of all, to Bhargavi for her awesome comments and to Soma for leading the discussion here. I think there are a number of different issues that are arising here. And one thing I think I would just like to make 100% clear is that I do not think this is market abuse in any sense whatsoever, right? This is not market abuse at all. This is a more, this is trying to connect a kind of economic concept of insider trading to what is happening here in terms of the small cohort of HFT traders having this foresight of information and the advantages that brings. That is really the economic concept. There's clearly no legal insider trading going on here. This is completely above board, 100% in this regard. The question is, what to do about it? What to do about this? Bhargavi made a great point in terms of, focusing on individual aspects of the phenomenon. Do we focus on co-location, direct feeds? Do we focus on automation in responses? And I think, focusing on every individual aspect is not going to do the job, right? We cannot ban co-location. We cannot ban data feeds because more people benefit from them than just HFTs, right? So we need to have, if we think about this, we need to have a more structural approach in this context. Now, one potential aspect that's been suggested here is a notion of batch auctions, right? The ability to have small auctions that have the effect of encouraging traders to compete on price rather than competing on speed. And I think, a more structural response is a way forward in trying to equalize the cost between different cohorts of traders so that one or other group of traders does not have a systematic advantage in price formation in this market. I think there are several incredibly important points that have been raised around the table in this case. And one important point here is, when does information become public? And what kind of information is this? There's a real confusion here. This really is a public good in the larger sense, but it's a proprietary good in the smaller sense. Different exchanges are monetizing this information for their own private good. And they're creating an enormous space in which they're deriving incredible rents from their information and from their access to this information. And what's happening in the US is that there's no regulation as to when information is essentially required to be received by investors. The only thing that regulation says is that information has to be entered into the SIP and into the direct feed at the same time. Now, what this means in practice is that information that goes into the direct feed necessarily reaches the co-located servers first, right? That's the only obligation that exists. Information becomes public as soon as it's input into the direct feed and the SIP at exactly the same time, and that's the extent of the regulation, right? The fact that investors do not need to receive it at the same time, and I think that's a difference from the Indian approach here. One other point, just to come back to Soma's observation, in the US it's completely legal for exchanges to receive liquidity, to give liquidity rebates to HFT traders. That is to say that HFT traders are receiving kickbacks, you want to call it, kickbacks as you refer to it, but that's really what it is, that the more liquidity they make on the market, they get paid for bringing that liquidity. That makes it more lucrative for them to engage in HFT. And if we think about this from the market perspective, maybe that's a good thing or not. The specific issue in this paper is looking at informational access and the allocation of informational costs in this space. And finally, I think, coming back to, the technology question that you asked there's a whole separate sort of literature and regulation on the technological snafus that seem to be happening on a daily basis. In the US, there are approximately, on average, 13 flash crashes that happen every single day, right? And now there's a whole slew of regulation that is happening that is designed to catch and make responsible broker-dealers and exchanges in particular for having safe technology standards. So there is an increased sense that we need more regulation here, but what hasn't been tackled really is a sort of broader conceptual question, one that you kind of referred to earlier, is what is the impact of a certain cohort of traders having first access to information? How does that impact and change corporate insider trading policy more generally, and how can we maybe encourage investors in the market in general to have a greater sense of participation in that space?
Okay, so if there are any more questions, yeah.
I have a question on, you compare the what's available to HFTs to the retail feed on CNBC. That raises a whole host of issues on what institutions have access to versus retail investors. I was wondering if you could compare what HFTs get compared to what your average mutual fund gets or your average institutional investor gets, and is that a more comparable set of data?
Yeah, I think,
There's one more question in the back.
Sorry.
And if there are any questions for Dr. Krishnan of the first session, table that too, since you're feeling tight.
Yeah, I've got a question. It could be interesting to see the pricing that the exchanges have. For example, somebody mentioned, Professor Yadav mentioned that 14 lakh rupees are being charged for co-location in the NSE. So, what is the pricing in other exchanges, and what that could possibly give an indication for the motivation and for people to go and co-locate, and that's the value for the advantage of being ahead of time in terms of the pricing, in terms of the price formation.
May I ask a question, please?
Yeah, sure.
See, I just one question for information, whether the HFT phenomenon is there also in ETFs, exchange traded funds.
Okay. Yeah, Mandar.
So, just moving on from, your comments earlier, if it's not a question of market abuse, then what is the externality on the basis of which, as a function of which regulation can follow? Like, is it documented that bid-ask spreads have increased in the US pursuant to, the HFT, increase in HFT and the like? Or is there any other externality? Because my reading of it and studies emanating from a professor at Columbia Business School is in fact the other, run contrary. He's found that liquidity and bid-ask spreads in fact go down. So, what is the externality? Because, absent fiduciary obligation, front-running of itself cannot be, something that can be a subject of regulation. Thanks.
Okay. Venkat and Dr. Yadav.
Yesha, I just wanted to add one more dimension to what you have done. See, I've followed the US markets for many years, and in the 2000s, early 2000s, when all these ECNs started coming up, NYSE made the big pitch that a lot of these ECNs were just matching the price from the primary market, and they were not actually adding value, but they were getting all the order flow. So NYSE actually made the case to the SEC at that time that the price that they produce is their information, so they can actually hold it back from the marketplace because other people are exploiting it at their disadvantage. And so, but the SEC shot it down. So now the market structure is so different that there's no single market which dominates. So really nobody is making that same claim. But I can imagine this happening in markets like India when you have a primary market which dominates price discovery, and then you have other markets coming up. And as Bhagwan was saying, competition is coming up. Then you have this issue of, can anybody, like all these dark pools, right? They don't actually produce prices. They just match the best market's price. So in that case, what is the value that they add to the system in terms of, and should the primary market actually face the consequences of their actions? And so I think coming back to my original point, I think the focus is no longer on the firms, but on the exchanges, because they have become very big players and peddling information to their advantage to the disadvantage of the larger public. But I don't think it affects the cost of capital. I mean, these are very micro level issues that I don't think it affects the firms to start with.
Mine is not a question. It's actually just a comment to the comment you made about kickbacks. The word kickback is pejorative, and I don't think it's appropriate. There is a very important function for liquidity supply in the market, and we are in a market where liquidity supply is entirely voluntary, and that liquidity supply can dry up in a fraction of a second when the various traders move out of the market, and therefore maker-taker fees are something which exchanges have done and to be able to ensure that there is liquidity available to anyone who wants to trade. And in a new world of HFT trading, as we will see tomorrow, there is very strong evidence that algorithmic traders and HFT traders withdraw from the market much quicker than anybody else.
I'll take it offline.
Pejorative is all I'm objecting to.
No, to me, the word insider trading itself is pejorative.
Sure.
To say it's a structure that promotes.
I'm just talking about the kickback.
Yeah.
So can I thank everyone for their comments? This was really extremely useful for me. Thank you very, very much.
Thank you.